Straight line method of depreciation. This is our second video of this chapter number 4. A straight line method means where you charge a depreciation that gives you equal amount of depreciation every year. There are two formulas we've got to learn. We're going to go over, and let's check out what they are saying. This is a very common method of depreciation. Most of the business, they use this method. The depreciable amount is charged in equal installments, as we said, in each accounting period over the expected useful life of the asset. In this way, the carrying amount of non-current asset declines at a steady rate, or a straight line rate over the time. Carrying amount means net book value of the asset goes down at a similar steady rate. The depreciation charge is same every year. That's true. Formula to learn. This is a common formula for a straight line method of depreciation, which is cost minus residual value or scrap value over a useful life. Means how many years the asset we're going to use it for. In our previous example, last video, 10,000 was the cost. Less, we said 1,000 is the scrap value or residual value, also known as sellable value, salvage value, different names, and divided by number of years, 10 years, equals to, what are you gonna get? If that's just imaginary figure we're doing, 9,000 divided by 10, 900 is depreciation charge every year. Okay, this is the depreciation charge every year. That's how you calculate depreciation. Or you can calculate this way: cost minus residual value and times by a certain percentage. Let's assume 10%. They said charge 10% depreciation on this way. So how do you do it? If this is the case, 10,000 is the cost of the asset, let's assume, minus residual value is 1,000, which is basically 9,000, isn't it? 9,000, and we said times by a percentage 10%, you still get 900. This is the two way of doing depreciation. Remember, the straight line method is suitable, which are used up evenly over the assets are used evenly over the useful life. For example, it could be a building, it could be a furniture, fixtures and fittings. These are mostly we use a straight line method because it is evenly used every year. It's not a machinery like first few years heavily used and next few years the machine become weaker, the usage become less. It's not like that. For that we're going to use diminishing or reducing balance method, right? Now we have given with some activity number 1 in front of us. Straight line depreciation. A machine. A business buys a machine for 2,500. So what's that? That is your cost, isn't it? And remember the formula, there are the two formulas. Then it is expected to have a useful life of 3 years. How many years? 3 years. So we got two information so far, after which time it will have a scrap value of 250. So we got our 3 items: cost, life of the asset, and scrap value. First is cost, second is life of the asset, and third is scrap value or residual value. You've been asked to calculate the annual depreciation charge. We're going to use our formula, and the formula is, what's the formula? Cost minus residual value over useful life or number of years, we call it. Useful life. The cost is 2,500. Scrap value or residual value is minus 250 over how many years? 3 years. So let's take out our calculator. 2,500 minus 250 divided by 3. 750 is your depreciation. That's such a simple stuff to do. In part B, we are going to do something very interesting. accumulated depreciation. And what is the fundamental idea of accumulated depreciation? These are depreciation which are kept from years after years, like last year's, year before, all depreciation added up together, including this year's depreciation, gives you accumulated or provision for depreciation. So what they're talking about, calculate the cost, number one thing, accumulated depreciation, number two thing, and carrying amount for each year. So, you know, cost minus accumulated depre equals to net book value or carrying amount. The cost is 2,500. IS 16 says cost will remain cost every year. It will be unchanged. Okay, that's the cost method of recognizing your non-current asset. Cost doesn't change, but yes, depreciation change. First year you had a depreciation of 750. Depreciation is each year basically, you know, that is charge. And you know, this depreciation goes into income statement or SPL, statement of profit and loss. Depreciation charge goes into the income statement or SPL, statement of profit and loss account. This is SPL, the 750, as an expense. Later chapter we need this idea, so stay focused on this video. But what is accumulated? Accumulated means when you add first year with second year, you get accumulated depre for the second year. First year is nothing to accumulate because there was no depre from last year. So 750 is your accumulated depreciation. So 2,500 minus 750, you get 1,750 is your carrying amount. But the second year, how much should be your accumulated depreciation? Last year we already have 750 plus this year 750, so 1,500, right? That is your accumulated depreciation, people. Taken away from this, I can do easily mental maths now, 1,000, yeah? Okay, and the third year, how much should be the accumulated depreciation? Accumulated is all added up together, 750, 750 and 750, or 1,500 plus 750, whatever you do. So 1,500 plus 750, which is 2,250. 2,250 means added up all first year, second year and third year, all depreciation together. So 2,500 minus 2,250, which gives you 250 only. That is your carrying amount. That means at the end of your year 3, the carrying value of your non-current asset would be £250, and that is your scrap value basically. That's what amount you can sell it for. Okay, people, so just winding it up in 1 minute or in just few seconds, this 3 column is actually your SOFP column. SOFP, state financial position. This is the first item you write as a non-current asset, the top 3 column, yeah? But depreciation charge, these are the item, these are charged into the income statement, SPL, as an expense. Okay, let's go to the next one. There is another activity with the straight line method of depreciation is on the building. A business has the following balances relating to non-current assets. Balances 30th June 2015 and 30th June 2016. That means this is opening balance, this is closing balance. You've been given building at cost. The cost remain every year is the same, 100,000. Building accumulated depreciation given, opening given 12,000, closing you need to calculate, it's unknown. And what do you mean by the accumulated depreciation? Means last year's depreciation added up all together. It's a combined all of your depreciation, which gives you 12,000. Now depreciation is provided at 2% on a straight line basis. That is the clause. You need to charge depreciation 2% on a straight line basis. Means you need to charge on what cost? 2%, isn't it? So our cost here is 100,000. If I do 2%, I do get 2,000. That should be my charge for the SPL. Let's see what is being asked into the question. Calculate the depreciation charge for the year ended. Yeah, that is charge. Charge means it goes into SPL, statement of profit and loss. 2,000 is your answer. And calculate the updated in number B. updated accumulated depreciation for June 2016. Updated means, look at this here. This is not updated, it's to be calculated. So last year's depreciation of 12,000 and this year's depreciation is 2,000. So that's it. We got to add last accumulated depreciation is 12 and this year's depreciation we need to add with last year's to get our accumulated, which is 14,000. This year we got to, isn't it? 14,000, and that should be your answer for accumulated depreciation. Okay people, so that was the straight line method of depreciation. Next is diminishing balance. So see you in the next video.